Human beings love to make predictions, but we're not very good at it. So basing your investment strategy on predictions is a really bad idea. At the start of every year, financial commentators make predictions about how the markets will perform over the next 12 months. Almost invariably, those predictions are woefully inaccurate. Here's Joe Wiggins.
Yeah, I would encourage everyone to ignore those predictions, because what you'll see is the majority will be wrong, and someone might be right, but whoever is right will change on a year-by-year basis, so we should ignore this type of thinking entirely.
One of the reasons why investors give credence to the predictions of experts is that they're seduced by data. We're deluged by data nowadays, but that hasn't improved the accuracy of market forecasts.
More is not better. But the problem is, it's not that the accuracy increases, it's our confidence increases, and we think we're doing better because we've got lots more options. So unfortunately, like money, more data doesn't make you happier, smarter, or more accurate. It's only more comforting.
It's not that the people who make these predictions are unintelligent. Most of them are extremely smart. It's just that it's almost impossible to make accurate market predictions on anything like a consistent basis.
Why are markets hard to predict? Well, firstly, the world is hard to predict. Things come out of left field all the time. We've had a number of examples. I mean, who among us thought we were going to be shut up at home for several months on our own during a pandemic globally? So the world throws a lot of curveballs at us, which is one reason. But more than that, the market is filtering information through millions and millions of different people, all interacting in incredibly complex ways. And even if something happens that seems incontrovertibly bad or incontrovertibly good, some of that will be priced in and some of it won't. Now, just because something bad happens doesn't mean that the market is going to drop as a result, because if there's a substantial portion of people out there who are prepared for that or waiting for it, or maybe were prepared for something else that didn't happen, the market level may not move despite what happens in the world. So there's all sorts of hugely complex, chaotic things going on that mean that markets are incredibly difficult to predict. And as individuals, our ability to out-predict the millions of other people out there, some of whom are big institutions who are incredibly well-funded with lots of smart people and huge amounts of data and processing power, the fact that we think as individuals we're going to out-predict the huge machine that is the collective intelligence of the entire market is hubristic.
Why then do commentators keep making market predictions in the media when they're so fiendishly hard to get right? It's partly because that's what's expected of them, and the wrong calls they've made in the past usually go unchallenged. Even relatively sophisticated investors who realise that market predictions are hit and miss still pay attention to them. Why is that?
It's a puzzle, isn't it? I think it gives us a comfort that the world is more certain than it is, and that we can make these predictions, so we're more likely to understand what's going on in financial markets, more likely to be able to invest in the right areas. It's a very difficult puzzle, and one that is quite troubling and dangerous for investors, because it's hard to be a long-term investor when we're seeing people make short-term confident predictions about what's going to happen in markets.
Human beings like making predictions about the future because they make us feel comfortable. We don't like uncertainty, and we do like narratives, and we do like stories. So you can see these things all come around in circles. A prediction is effectively a story about the future. It's a narrative about the future. It gives us comfort. It gives us confidence. It gives us the ability to act. And we would all much rather, sadly, hear someone tell us with very high conviction exactly what's going to happen next month than someone who exposes the brute force truth, which is genuinely, I don't know.
And that's a real problem when it comes to choosing an advisor. People naturally warm to advisors who make confident predictions.
When we hire an advisor, we're looking for someone who we think is competent. But the key question is, how do we judge competence? In some areas, it's easy to do. In some areas, it's hard. It's just far harder to do when we don't have the base background knowledge. So What do we do in those type of scenarios? Well, there's a pretty robust body of evidence that says that the primary judgment tool that we use as individuals is how much confidence the person on the other side of the table is expressing to us. We actually use confidence as a proxy for competence.
So what's the answer? Well, we can't avoid making predictions altogether as investors, but we can make a distinction between the predictions we can reasonably make and those we can't.
The distinction I would make is anything that's a short-term prediction based on market sentiment is one we should steer clear of and be very sceptical about. And by short-term, I don't mean days. I mean a year is still short-term for making investment decisions and judgments. But let's say we made a prediction, which is a type of prediction that we think equities will produce positive real returns over the next 30 years. That's a reasonably robust prediction backed up by evidence, and where we are letting fundamental factors like the power of earnings and dividends compounding over time make it a much more sensible prediction to make. As soon as we veer into the realm of predicting short-term market fluctuations and events, we know that the odds of being consistently right, or even more right than wrong, are incredibly low.
Perhaps the best way to curb prediction addiction is to diversify your investments and to stay diversified.
Your fundamental baseline engine room portfolio should be just a brute force diversification. Buy a little bit of everything. Once you're invested in a diversified portfolio, the less you touch it over the next 10 years, the likelihood is the better you will do.
So I always say that the best sign of an investor's confidence in the future is the level of diversification or concentration in a portfolio. And that can be concentration in a particular stock or fund or asset class or even theme or story. The more confident we are of the future, the less diversified we are. If we knew the future and had a crystal ball, we just buy one security. So by remaining diversified in a way that's appropriate for our own long-run objectives, that's the best protection against making those types of predictions, because if we're sensibly diversified, we don't need to be reliant on short-term predictions.
So, in summary, ignore market forecasts altogether. If you have to make predictions, prepare for a wide range of outcomes and focus on what really matters. Crucially, keep your investments diversified. You will almost certainly be better off in the long run.